I'm going to quickly run through these bond valuation example problems just to give you guys a sense of and a reminder of how to solve them. They're very similar to what we saw back in the time value of money chapter, except in this case we're applying those concepts specifically to corporate bonds and corporate bond valuation. So let's look at the first example. In the first one, we're looking at the effect of a fall in the interest rate level. So what you guys will need to do is given the problem, understand what you know and what you don't know so that you can solve it in the financial calculator. And in this case, we have a corporate bond that has 9 years left until it matures. Its annual coupon payment is 8%, and its par value is $1,000. The par value represents the payment at the very end of the bond, that is the principal that's repaid to the lender. In this case, we're saying interest rates have fallen to 5%, so maybe they've gone from 8 to 5%, and so the question is what happens to the price of the bond. So we can go over to the calculator and input what we know. First, we press reset. We know that there's 9 years left on the life of the bond, so that's what we're going to put for our in. We know the par value is 1,000. And so we will assign that as our future value. And the old interest rate was 8%, and the new interest rate is 5%. So how do we input that into the calculator? Well, the coupon rate is 8%, which means that it pays 8% on the 1,000, which means it pays $80 a year. So 80 is going to be our payment, and 5 is going to be the interest per year. What we don't know is the price of the bond, and that it's the same thing as the present value. So that's what we're going to solve for. So we press compute, present value, and that means the present value of that bond today, the value of the bond is $1,213. And the calculator shows up as negative because the calculator has to balance the cash flows out. And so basically what it's saying is that we would be willing to pay $1,213 for a bond that pays $80 a year with a par value of 1,000 with 9 years left. Okay. So question 2 is what happens if there's a rise in the interest rate? So in this case, for the bond, there's the same assumptions, 9 years left, coupon payment of 8%, and par value of 1,000. But in this case, interest rates have risen to 12%. So we can go back to the calculator, and instead of 5 for the interest, what we're going to do is 12%. All the other assumptions are the same, so now we just recompute the present value, and that gives us $786. So you can see between the two, when interest rates have risen, the bond price falls below its par value and it starts trading at what we call a discount. Whereas if we go back to example 1, where interest rates have fallen, the par value is 1,000, but the bond is trading above 1,000. So we would say that it's trading at a premium. So example 3 is when there's a decline in creditworthiness. So suppose that interest rates stay the same, but the creditworthiness of the borrower changes, which means the company becomes either more risky or less risky. And in this case, the borrower has become more risky. So we can look at the assumptions of the bond. Corporate bond is 5 years left until it matures. Coupon rate is 6%. Par value is 1,000. So what does that mean? Because the coupon rate is 6%, it means the coupon payment is going to be $60, 6% of that 1,000. So So what's happened to this company is that they've been downgraded, right? So they were AAA before, but now they're BBB. AAA rates are around 6%, BBB rates are 9%. So new investors that purchase this bond now have a required rate of return of 9%. So what does that imply about the price of the bond? And how do we do that in the calculator? So we can go back to the calculator, reset the calculator from our previous question, and input the new variable. So 5 years left of maturity, coupon payment of $60, par value of $1,000. Let's input that information. Par value is going to be our future value of $1,000. $60 payments, 5 years left. And lastly, the impact of the credit downgrade, which made the required rate of return go to 9%. So that's what we're going to input into the interest rate. Oops. At this point, we're computing the price of the bond. So we press compute, present value, and that gives us the price. So because the borrower was downgraded from AAA to BBB, required rates of return rose for their bond, and which meant that the price of the bond fell. Right? So any investors who held the bond before the downgrade, now suffered a loss in their portfolio. The fourth example is basically the same thing, except this time we're looking at an upgrade. So now the company was BBB before, but now it's much healthier, and now it's AAA. And all the other assumptions are the same. So initially, when it issued the bond, it was at 9% because it was BBB. But now that it's improved, AAA rates are at 6%. So now required returns for the bond are only 6%. So, so what do we know? 5 years left. So that's going to be a number of periods. Coupon rate is 9%, which means their coupon payment is $90, and par value is $1,000. So 5 years left. $1,000 par value. $90 coupon payment. And lastly, 6% required rate of return. Compute the present value. And now the price of the bond is $1,126. So what was the impact of the credit improvement or the upgrade in their credit rating? Well, the price of the bond rose, and that's because the required rate of return fell. So anybody who was holding the bond before when it was BBB, and since it was upgraded to AAA, experienced an improvement in the value of their portfolio. All right, example 5 looks at the impact of advancement toward maturity. So the initial characteristics of the bond has 10 years left until maturity, coupon rate is 5%, and its par value is $1,000. Let's say market interest rates today are at 7%. What's the price of the bond? So coupon rate is 5%, which means the coupon payment is $50, 5% of $1,000. We input 10 for 10 years left of maturity. $1,000 par value. $50 coupon payment. And 7% market interest rate. And we compute the current price of the bond today, which is $8.59. So with 10 years left, the price of the bond is $859. The real point of the question is to show you guys what happens as the bond advances toward maturity, even if interest rates don't change. So let's say interest rates remain at 7%, but now we're 5 years into the future, and there's only 5 years left on the bond. So what happens to the bond's price? Well, go back to the calculator, and instead of 10 for the number of periods, we're going to replace that with 5. So the bond at 10 was at $8.59, so we recompute it at 5 years, and it's $9.18. So why did the bond price increase? Well, in this case, the bond was trading at a discount, right? It was trading less than par value. And over time, as bonds advance toward their maturity, their prices converge to the par value. Because eventually, at the end of the life of the bond, $1,000, the par value is what investors ultimately receive. So the closer you get to the end of the life of the bond, the closer the price becomes to, it eventually converges to 1,000. So in this case, the price of the bond was discounted below par value, and so the price increased. But you also have the reverse scenario where the price of the bond could have been trading at a premium above par value. In that case, as the bond advances toward maturity, the price falls until it hits 1,000 at the end of the life of the bond. All right, so let's look at example 6, where we compute the yield to maturity. So in this case, the corporate bond has 5 years left to maturity. Coupon rate is 10%, and par value is 1,000. Coupon rate is 10%. That means that what the firm is paying, its coupon payment, is $100, which is 10% of 1,000. The current market interest rate is 8%. So let's say you're a bond trader and you see that this bond is currently trading at $1,050. Is it a good deal? Is it something you want to buy? That's what you're asking yourself. So first, let's compute, given this current price, what is the yield to maturity? And if you were to buy it today at $1,050, the yield to maturity gives you an idea of what your return would be. So, is it greater or less than today's market going rate of 8%? So, let's input what we know into the calculator. You can input par value, which is the future value. 5 years left, coupon payment is $100. 5 years. $100 payment, and the current price is $1,050, and we're computing the yield to maturity. To do that, we put $1,050 negative, because that's what we would be paying for it as a present value, and then we compute the interest per year. And this 8.72 reflects the yield to maturity. If I bought this bond today at $1,050, then my yield to maturity would be 8.72%. The current market interest rate is 8%, right? So the fact that if I purchase this bond, I would be earning more than 8%, it's very enticing to me as an investor. There's another way of going about it, which is option 2, which is computing the bond's expected price at the 8% rate. So let's forget that we had just computed the yield to maturity. We can reset everything. So 5 years, $1,000 par value, and $100 coupon payments. and market interest rates of 8%. Compute the price of the bond, $1,079. So basically this tells me that I'm not willing to pay any more than $1,079 for this bond. Well, the good thing is it's trading less than that, right? And so to me that sounds like a good deal. So the bottom line here is that the current market interest rate is 8%. The bond is currently trading at this price of $1,050, and the question is that a good deal? And we saw from either option 1 or option 2, they both get at the same thing, that yes, it is a good deal. Because option 1, when I computed the yield to maturity, it's greater than 8%, which is a good thing. Option 2, when I computed the bond's expected price, it was above the price that it's currently trading at, which signifies that it's a good deal. Okay, so let's really quick, example 7, we don't really have to calculate anything. But let's say there's a corporate bond, 10 years left to maturity. Its coupon rate is 5% and its par value is $1,000. Coupon rate being at 5% means that it's paying $50 on that $1,000 bond, par value. So suppose today's interest rates are at 7%. Does the company call the bond? Well, when the company calls the bond, that means they retire it early, right? Which means that they end the bond and they can potentially get a new bond. Well, they don't necessarily want to do that when interest rates have risen to 7%, because if they did it then and refinanced at 7%, it would be more costly. But if you suppose that interest rates today are 3%, and now you're asking whether the company would call the bond, in that case, it kind of makes sense, right? Because now if they refinanced from 5% to 3%, their coupon payment would go from 50 to 30, which would make it cheaper. Lastly, we can compare a corporate bond that has 10 years left to maturity, coupon rate of 5%, par value of $1,000. Let's say market interest rates go to 3%. What is the price of the bond? So first, let's compute that bond's price. Reset the calculator. 5% meaning it's paying $50 as a coupon payment. So 10 years left to maturity, $1,000 par value, $50 payment, and interest market rates today are at 3%. Current price of the bond is $1,170. Let me mark it here. Oops. Now compare a similar bond that has a call feature and can be called after 5 years. Because market interest rates have fallen, the company will definitely call the bond at the 5-year mark and only has to pay par value. So in this case, the life of the bond is no longer 10 years, but now it's 5 years, because the company can call the bond after 5 years, and because market rates are lower than 5%, they're at 3%, the company will definitely call the bond. Okay? So if that's the case, what is the new price of the bond? Is it greater or less than or equal to the current price of the bond without that call feature? Okay, so what we might do is, instead of giving the life of the bond 10 years, we give it 5, because it's definitely going to be called back after 5 years. Recompute the price of the bond, and it's now $1,091. Right? So the point of this exercise was to show that, let's see, $1,170. So the point of this exercise was to show that the call feature in the bond, called a callable bond, is not necessarily a good thing for the bondholder, in the sense that the only time the company is going to refinance is when it's in its favor, the company's favor, which happens to be opposite to the favor of the bondholder. Right? So the callable bond is going to be priced slightly less than the non-callable bond. And you can see this where, given the conditions, callable after 5 years, company will definitely call the bond because interest rates are less than 5%. It reduces the value of the bond. So is the call feature a good thing for the bondholder? No. And because of that, the price of the bond has to be lower.